Hello, welcome to the session. Today we will discuss the important chapter of financial management, that is dividend policy. I am Dr. Manish Dadij from Sir Padampat Singhania University, Udaipur. Well, dividend refers to reward, cash or otherwise that a company gives to its shareholders. It can be issued in various forms such as cash, stock, scrip, etc. Usually, board of director of a company decides dividend policy and further requires approval of shareholders. So in this tutorial, we will study what is dividend, various forms or types of dividend, theories of dividend policy. There are two major parameters on which all dividend policies are divided. One is relevance theory, under which there are two models for the dividend policy. One is the Walter model and second is the Gorden model. If we talk about the irrelevance dividend theory, there is one model, we call it Modigliani and Miller model or M-M model or M-M approach. Now take a look of what is dividend. Dividend is a part of the profit that a company shares with its shareholders. Dividend are also a portion of a company's earning which it returns to its investor, usually in form of cash. Further, choice of returning some portion of its earning to investor as a dividend or of retaining the cash to fund for internal development project, it all depends on company's dividend policies. There are various forms or types of dividend, and of course there are certain component or the principles on which we can divide the forms or types of dividend. The first one, on the basis of types of shares. We know that there are two types of share. One is equity and second is preference share. When dividend distributes to existing equity shareholders, it is equity dividend, and same in case of preference shares. Second, on the basis of mode of payment. Number one is cash dividend. It is the most typical mode to distribute the dividend. The Company Act 2013 also states that the dividend should be paid only in cash. So this was the cash dividend. But there are other modes also, like stock or bonus dividend. When a company issues additional shares or extra share to its existing shareholder, it is known as bonus or stock dividend. Next is scrip dividend. It is also known as dividend in the form of promissory note, in which a company issues this note and promise to pay some sort of dividend over a period of time. And the last, when company pays a lump sum dividend or accumulated dividend at given period of time, it is known as composite dividend. There is another basis which is based on the time period, time of payment. Number one is interim dividend. When a company issues dividend or distribute dividend in between financial year, it is known as interim dividend. Second is regular dividend. After completing the financial year, let's say about 31st March, there will be board of directors meeting, there will be approval process, and after that, if company issues dividend, it would account for regular dividend. Next, special dividend. When a employee of a company performs extraordinary, so in that case, the company cannot give like the cash remuneration to that employee, but may issue some sort of dividend or share which is known as special dividend. Liquidity dividend is the case when board of director decides to pay back the original capital contributed by equity shareholder as a dividend. Now we will discuss what is dividend policy. According to Weston and Brigham, dividend policy determines the division of earning between payment to shareholder and retained earning. Here we need to understand what is retained earning. The general practice of a company states that the dividend or the net earning should not distribute to its shareholder. Rather, company keeps some sort of money or some sort of profit for future development. When a company keeps that money for the future perspective, it is known as retained earning. Moreover, dividend policy involves the three major decisions. Number one, to retain the earning for capital investment and other purposes. In this case, the company never distribute dividend. Second, to distribute earning in the form of dividend among shareholder. In this case, company never keeps retain earning. And in third case, some sort of money may distribute to existing shareholder and some may keep as a retained earning. Now come to types of various dividend policy. Number one, regular or stable dividend policy. All big or the blue chip company follow this kind of policy, in which company more emphasize on constant dividend per share, constant percentage of net earning, stable rupee dividend plus extra dividend. These are the forms of the regular dividend policy. When a company is growing or not able to pay dividend on regular basis, on a frequent basis, it would come in the category of irregular dividend policy. When company issues bonus dividend on regular basis, it would be regular bonus dividend. And most of the time, company never believes on distributing the dividend, so the fourth policy would be no immediate dividend. When company has sufficient reservoir in reserve and surplus account, then company may distribute dividend, but immediately there will be no provision of distributing dividend. Now we will discuss various types of policy. So as I already told you, there are two different approaches. Number one is dividend irrelevance theory, in which M-M hypothesis is there or M-M theory is there, and the second one is dividend relevance theory. In this theory there are two models, Walter model and Gorden model. First, we will take a look of relevance theories. In relevance theory, the first theory is Walter model. Professor James E. Walter propounded this theory, and the dividends are relevant and have a bearing on the firm's share price. Investment policy cannot be separated from dividend policy since both are interlinked. Walter used the dividend to optimize the wealth of the equity shareholders, and this model is based on the following assumptions. Number one, all the financing should be from internal sources. Next, constant return in cost of capital, 100% payout or retention ratio, constant EPS, that is earning per share, and DPS, and the company is meant for infinite time, and R and K. What is R and K? R is the rate of return and cost of capital remain constant. We will discuss further this R and K. Yes. So according to this model, it clearly shows that the relationship between the return on investment or the internal rate of return R and the cost of capital K. The efficiency of dividend policy can be shown through a relationship between return and cost. So in first case, if R means internal rate of return is more than cost of capital. In that case, the firm should retain the earning. It means in that case, the company never gonna distribute any dividend. Second, if K is greater than R, means cost of capital is greater than internal rate of return, the firm should pay all its earning to shareholder. There will be no provision of retained earning. And in third case, if R and K are same, the company dividend policy has no effect on firm's value and payout ratio can vary from 0 to 100, meaning thereby it is up to company, it is up to the board of director how much amount of earning they want to distribute as a dividend or how much they want to keep as a retained earning. It is the sole discretion of theirs. Now take a look of formula of Walter model. P equal to D plus R divided by K, E minus D divided by KE, where P is current market price of equity share, E we know that earning per share, D dividend per share, R I already explained you return rate of return, and K is cost of capital. We can understand it with the help of one numerical. A company has a following fact. I put a direct figure here. Cost of capital KE 10%, earning per share rupees 10, rate of return on investment is 8%, dividend payout ratio in case of A company 50%, in case of B company is 25%. Now we will check what is the effect of the dividend policy on the market price of the share. So the solution is also here. Here the DP ratio is 50% in company in case 1. When EPS 10, DP ratio is 50. So the D is 10% of 50, that is 5%. If we put all those figures in the above formula, we will get 19. Same in case of company B, where the DP ratio is 25%, EPS remains same, DP ratio is 25% of 10, that is 2.5, and in that case the market price is 85. So we can conclude that when the DP ratio is 50%, so here the market price of case A is also quite high than the case B. Here the 90 is greater than 85. So it shows that there is an impact of distributing dividend policy in the market. Now there are certain criticisms of the Walter model. Number one, no external financing, because the company cannot finance internally. It has to go for external sources to accumulate the money. Next, the firm's internal rate of return doesn't always remain constant. Nothing is constant except time, we know that. So this R cannot be constant. And same in the case of cost of capital remain constant, where in practically it doesn't. Now come to the Gorden model. Myron Gordon also supports the doctrine that dividends are relevant to the share price of a firm, meaning thereby if company distributes dividend, its market value of share will augment or come up. Thus, dividend affects the value of the firm, and explain how dividend policy can be used to maximize the wealth of the shareholders. Moreover, the main proposition of this model is that the value of a share reflects the value of the future dividend accruing to that share. Hence, the dividend payment and its growth are relevant in the valuation of shares. Again, it is based on certain assumptions. First, all the firms are equity firms, though it is not possible. Again, R and K, internal rate of return and cost of capital remain constant. indefinite life, constant return, constant retention ratio, and cost of capital is greater than the growth rate, means the K is greater than BR. BR is actually the G is the growth rate. It will be very clear when we will solve the numericals. Now this is the formula. So we can easily calculate market value of share with this formula, and it is equal to the present value of future dividend. So in that case, P is equal to E1 minus B divided by K minus BR, where the P price, E is earning per share, B is retention ratio. There is another methodology to calculate the retention ratio. The 1 minus DP is your retention ratio. K again cost of capital. BR represent the G is basically growth rate of a company. Now have a look of this numerical. Determine the value of share with the help of the following information. There are two cases, case A and case B, where the DP ratio is 40/30, retention ratio 60/70. How did we calculate this retention ratio? 1 minus 40%, that is 60, so 60 would be retention ratio. Cost of capital given 17%, 18%. Internal rate of return is 12%, 12%, both are same, and EPS is again same, 20 and 20. And this one is the formula again, and here is the answer. So if we put all those figure in that formula, we'll get 81.63 in case A and 62.50 in case B. Now what does this mean? It means when DP ratio in case A 40, so here the market price of share is 81 rupees. In case B, DP ratio is 30, so in case B the market price of share is 62, means less than the 81. So it's clearly states that the dividend ratio has a profound effect on the market price of company shares. Now come to the dividend irrelevance model, that is also known as Modigliani and Miller irrelevance model. According to this model, dividend policy has no effect on the price of share of the firm and believes that it is the investment policy that increase the firm's share value, meaning thereby the distribution of dividend is not at all related with the market price of the share. Why? Because value of share, that is the value of shareholder, depend on the firm's earning, and the firm's earning depend on the firm's investment policy, not on dividend policy. According to this concept, investors do not pay any importance to the dividend history of a company, and thus dividends are irrelevant in calculating the valuation of company. This theory is in direct contrast to the dividend relevance theory, which deems dividend to be important in valuation of a company. Now these are certain assumptions. Number one is perfect capital market, no tax, no taxation, constant investment policy, no uncertainty about the future profit, means you are pretty much sure that this much of the earning you are going to get definitely in near future. Next is investment and dividend decision are independent in nature, and there will be no flotation cost. There are certain criticism. Number one is no perfect capital market, as we already know that no one is perfect in the market. So this was the first criticism. Existence of transaction cost and the flotation cost, lack of relevant information, no fixed investment policy, and investors desire to obtain the current income only. So on behalf of that, we may say that the this policy is not pretty much relevant for those who believe that the dividend has profound effect on the market price of a company. Now, this is the formula of MM model. In order to satisfy their model, MM has started with the following valuation model. So P0 is equal to D1 plus P1 divided by 1 plus KE, where P0 is the present market price of a share, KE cost of equity shares, D1 is expected dividend after completing the year or at the end of year, and the P1 is expected market price at the end of year 1. Now we will solve one simple numerical based on this MM model. Yes, here is the example. A firm has a 1 lakh share outstanding and is planning to declare a dividend of rupees 5 at the end of current financial year. Current market price of a share is rupees 100, cost of equity 10%. Expected market price at the end of year 1 may be found under two conditions. See, this is very important. First, if dividend of rupees 5 is paid and if not paid, correct? So what would be the impact? In first case, if we distribute dividend, in second case, if we don't. So here is the formula. P0 is equal to D1 plus P1 divided by 1 plus KE. So we have like P0 is the 100, means the present market price of share. KE given in the question 10%. D1 dividend is rupees 5. So if we put all those figure again, the formula, we will get P1 is equal to 105, means the market value of share is 105 when we distribute dividend. Now what will happen if we don't distribute dividend? So here is the solution. So the market price is expected to be 105 if a firms pay dividend of rupees 5. That has already been clear. Now when dividend of rupees 5 is not paid, the value of D1 becomes 0. So the D1 becomes 0, then we get the P1 110. So 110 is more than 105 above here. So the market price of share is expected to be rupees 10 if firm doesn't pay any dividend. It means there is a irrelevance, there is no relationship between distributing the dividend and the market price of a share. Even if company doesn't distribute dividend, its earnings will be quite high. So this was the assumption given by MM model. I hope this session would be worthwhile for you, and thank you very much for your attention, and have a nice day.